Well, very good. It's I'm showing 2 minutes after 9 a.m. Pacific, and so on that note, let's begin. I just hit the recording button. So once again, welcome everyone. Good morning. If it is morning for you, my name is Glenn Thompson, and as you see on the screen, I work as a mentor with Pacific Trading Academy. I've been doing that for about almost 15 years now. You can reach us at our website or the toll-free with the information www.pacifictradingacademy.com, the toll-free number 1-800-339-8588. And today's topic, intermarket relationships and current trades. And see, it says Glenn will be with us shortly. Well, that's past tense. We're here. We're ready to begin. And let me just move this along. All right. Today's topic is intermarket relationships and current trades, and for those of you who didn't quite show up in the last minute, I said we are recording today's presentation. We archive it on our website, and it's also connected or linked to YouTube, so there are a number of ways in which case if you miss any portion of today, or if you would like to review it and hear it again, you can, and revisit and play it, and you can do it on YouTube and or our website. So I want to talk about some opportunities that I perceive occurring. Oh, well, one quick note I always mention for those of you who haven't attended any of my webinars. I've been giving webinars now for close to 2 years. Prior to that, had no experience, had no teaching experience prior to about 15, 16 years ago. I've been trading 34 years, and I'm a technician, and I primarily focus on the financial sector. But again, today's topic is just different intermarket relationships and some trades and situations and projections that I've made, and I think that will give us a good shot at generating some good returns. When I started, I was in my middle, or I think about 24, 25 years old, and a prevailing view of analysis at that time was volatility directly correlated with risk. That is certainly a view which is passé at this juncture. We need volatility, and the reason I think of that idea is this year in particular, so far, here we are through the 8th month, has been very, very volatile internally here in the US and globally. And as such, this is a good thing. This allows for what has been in my career personally, if not the best portion of my career, in the top 3 years or top areas of my career in terms of my success. So I'm happy to report that, and I project continued degrees and amounts of volatility in the months remaining in 2015 on into next year. There are a number of events fundamentally that have been occurring even as we exited 2014 that I perceive will continue for at least going out another year and a half or so. And the reason that's important is when you have multi-sigma events where you have large amounts of price dispersion, and it's happening often, it gives us great opportunities. Not all of them are going to be lend themselves perfectly for good entries and exits and round turn scenarios, but a good percentage of them have so far, and I anticipate will continue to do so. So if you have questions as I proceed through the slides in the presentation, if they're pretty straightforward and I can address them without kind of interrupting the flow of the slideshow, I'll do so. I have a little lesser number of slides than I typically do. You know, I always say, and I guess I spoke a couple of weeks ago and I say I'm going to be quick, and I always end up going over. So let me try and keep it to a minimum and be as cursory and concise as possible. So let's start. This is just a set of normal intermarket connections that I look for. Models and these inter correlations and these intermarket fundamental tendencies of response and action and reaction are simply guidelines. They're not, I don't treat them as gospel in a sense. They're certainly relationships that hold up frequently enough that we can place some stock in them. So you can. This is just essentially starting from the perspective that the U.S. currency, the dollar, serves as a driver for how other sectors of our domestic and our global economy work. So in general, just a quick overview, as you see here, when dollar strengthens, when the U.S. currency or dollar goes up, commodities in general go down, nominal bond prices rise, stocks rise. And the opposite is the case under all other variables kind of fixed for the moment. If we're in a vacuum, let's say, weakening dollar supports or tends to bid the price of the general commodity indexes or CRB index higher, or whatever, or commodity prices in general. Nominal bond prices go down, stocks tend to decline as well. So this set of relationships, utilizing the dollar again from the perspective of the dollar being the driver of some of these other sectors, important sectors of the financial of an entity's economy, is kind of a starting point. Now, if you go through a period of deflation or inflation, we have to adjust it, and so these are the bond-stock relationship tends to decorrelate or decouple. Bonds and stocks tend to act differently during periods of deflation versus periods of inflation. If anything, I would say currently for the last year or so, or at least the last 6 to 8 months, we would be tending towards a deflationary environment given all the economic data and the numbers that have been released in the last 6 to 8 months. I would say, if anything, it's price deflation. So curiously enough, as a later subsequent slide will show, bonds are going up right now. The longer, for the last month or two, for the last 4 to 6 months, bonds have been coming down on an interest rate bet, I guess. So I'll say more about that. So, but this is a starting point from the perspective again of the dollar being the ultimate or original driver of the other sectors of the economy. Guys, just let me do a check. Can you, Roy, you're the only one that's giving me feedback. Can everyone who's present here, and thank you, thanks again. I think someone's giving me a note. I just want to make sure you guys are seeing. Thanks, Mike. Okay, great. I am so not fearful, but about 2-3 months ago, I gave a presentation and got through about 75%, and come to find out people hadn't looked at my dashboard on the control panel area, and people could not hear, and so we had to redo it 3 days later. So I'm concerned about that. All right, great. All right, let's move on. And so this, again, I start here because I have always said for people who like to trade currencies or Forex in general, a general way, and I'm a technician, so, but I want to, when I say that, I'm not unaware of events that we refer to as fundamental. Information is information, be it quantitative, be it fundamental, be it coming off of a financial network, off of a website, or the premise of a technician that I primarily utilize and depend on is all information is contained or discounted in the price. So when you look at a price chart, it's essentially a graphic distillation of information. And I just work empirical results in my own trading career have proven time in and time out for me that they give me a more accurate, reliable forecast than if I were to attempt, in my efforts in the past, attempting to make sense of a series of events as they unfold in the world around me. It makes common sense and perfect common sense for me to try and resolve and figure out the interplay of activities and news events as they occur and how they might impact a market. I have just not been so successful at it through the years. So I found when I incorporated a technical view, which simply means I look at charts and various studies of the charts, I tend to ramp up and improve my accuracy. All right. So if we're starting, the point I was going to make there was the dollar. I always tell people if you're trading, if you have an interest in the Forex sector in general, and that would be on the futures side if you're a securities trader, and there are ETFs that are effective and liquid proxies for currency markets, or if you're trading spot in other pairs. In any event, any type of currency or Forex activity, Start from a global macro perspective. Imagine if a nation issued stock. Its currency would be its stock. So as things fare in a given sovereign entity, a state, a nation state, U.S. be it the America, the Europe bloc, Asia, etc. As things go, you contend that the stock will go, or its currency will move. If things go favorably, I can expect that to be reflected in appreciation in that currency for that area. If things are not going so well, overall, in the macro sense, at least, as a starting point of analysis of thinking about what you're projecting for that particular area's currency, you can expect it to decline. All right, long-term dollar view. This is a slide that I presented about almost a year and a half, about 16 months ago. This was back in May or April of 2014, this chart throws, but I wanted to present it as a way of showing where we came from. This is going back as a weekly continuation of, at the time, what was the June contract in the US dollar, and it's a continuation chart going back to 09. So you can see a low point back in 2000, this is January, February, March, April. This arrow points to the bottom in the US dollar index. Look at the level. We're kind of just in the 73 area, maybe 72 and a half, 73 price area. And then look how high we've come. And then we kind of, how we move from there. Overall, since, again, 2011, general appreciation in dollar values. You can see, and then over here, this is about 16 months ago. This is last April. In April of 14 is where this chart leaves off. You can see we're just below 80 on the scale of the US dollar index. All right, this is fast forward to the present. I printed this screen out yesterday. This is a long-term weekly chart. So again, the preceding slide, just to get your bearings and sea legs in place here. This is last April 2014. Here's where we are as of yesterday's close. You can see last April we were at just under, right in here. Here's that, let's see, if right in here, just in the 80 cent or 80 point value area. And look at talk about volatility. From April of 2014, we were trading below 80. Look at where look at the motion and the trajectory of the market. It just took off like a rocket in terms of dollar. You can see a little wave structure for those of you who understand the wave principle. 1, 2, I don't know, this would be your 3, this may be your 4, and this might be the 5th, or the entire move up to the entire peak on the screen may be your 3, and everything subsequent to that through yesterday could be a fourth wave. However we want to look at it, and that's an interesting relationship. But this shows, going back to 2011, the longer term, a multi-year global perspective of dollar appreciation. It's significantly strong. And interesting, one point that I'll think about with regard to the dollar, because it causes me to think and conjecture what next for the US dollar. Again, going back to that initial slide of some of the other major sectors of the economy, the interest rates, that is the bonds, precious metals, oils, or energy, stocks in the equity sector, to the extent they're correlated with dollar. If the dollar is the driver of these things globally, the fate of the dollar and my future projections will in turn enable me to get some semblance of accuracy for the other sectors. But here's down below, this is the CFTC's COT report, Commitment of Traders. Look at the red line. That's your commercial activity declining. All the while the dollar values inclined or were bid up. During that period of appreciation where it took off like a rocket, commercials were getting more and more net short. And so essentially we interpret the commercial positioning as a leading harbinger or a leading indicator of what's to come. The challenge here in interpreting the COT report is trying to figure out with accuracy what's the lead time, what's the amount of time, and that's all sorts of market people and researchers and clever ideas and relationships have been developed to try and enable us to more consistently have confidence in our assessment of what actually is the lead time between how much of a lead between the commercial positioning, their net positioning, and what the market's doing. But essentially, now we're not at the lowest level, but you can see going back from 2011 to the present, the net commercial positioning has been increasingly declining, or increasingly short, I should say, to be precise here. Let's see, someone's asking maybe, okay, let me just quickly, in my earlier slides, bonds referred to interest rate yields and not the bond price with respect to increasing, decreasing relationships. Mike's asking, I'm not quite sure if I understand. When I show the bond chart, it's the nominal bond price. So you're looking at it, kind of think of it, it's inversely related. I'm not sure if I'm addressing your question. Hopefully I will, but if not, I'll come back to it. But interest rate yields and not bond price with respect to increasing, decreasing relationships. What? Oh, I think I understand your question. The intermarket relationship slide, the first slide I showed, is referring to the nominal price of bonds, not the interest rate. So again, let me quickly go back for that. That's quick enough. Yeah, just to clarify that, make sure we're on the same, everyone's on the same page. Yeah, this relationship, when I refer to bonds, it's not the interest rate. I'm talking about the bond price itself. So bonds, okay, here's a thought. When under normal circumstances, US dollar appreciates, I can expect the nominal price of the bond, I'm not talking about an interest rate rise, or vice versa. If the dollar declines, the nominal price of the bond would go down based on, if to the extent these relationships hold. I'm not suggesting that these are perfectly certain. There are times when some of these relationships and intermarket correlations break down, but essentially this is a set of relationships that I find are going to work 65 to 70% of the time. There are times when they don't hold, so we have to, these are not perfect, but they work again with a frequency large enough at the time so as to place some stock in them. If I isolated the bond situation, just to be overly simplistic, I think, I hope not, but you know, in general, raising higher rates inversely correspond to the nominal bond prices. Interest rates tend to go up, nominal bonds prices decline, and vice versa. When rates decline, bond prices go down. Or excuse me, bond prices go up when the interest rate declines. Okay, so that hopefully clarifies that. Hopefully I think I was getting, but that slide refers to the nominal bond price, not the interest rate. Hopefully that correlation slide. Okay, very good. Thanks. Okay, great, Mike. All right. So let's get back on track. So this was the long-term dollar. This is a chart leaving off about a little less than a year and a half ago, about April of 2014. Fast forward to today. This is through today. You can see it just shot up like a rocket. So a lot happened in the last almost year and a half in the US dollar. Significant appreciation. By the way, when I gave that presentation, again, just about 16 months ago, one of the biggest plays and trades and opportunities that I foresaw on the horizon and that I talked about going into the end of last year, and we were able to exploit it. One of the best trades situations we had earlier from the end of last year through the beginning quarter or even into the second quarter of this year, I exploited this relationship on the spot pair in dollar yen. In a very in and out in a position trade type of way, and shorter terms, kind of a swing trade situations. So there are a lot of ways to exploit a projection, and so we had some signals earlier this year, starting actually at the final quarter of 2014 and moving on into this year, where we were able to. We didn't get the entirety of this move, but we caught certain fractions of, you know, this move a number of times. I did it precisely for the most part in dollar yen spot pair. Anyway, that's that. Here's just a more granularity view of the dollar. It's just a daily chart of the September dollar index printed out yesterday. So there are a couple of thoughts, because the question is, to the extent we hold the intermarket correlations that the initial slide depicted, we want to, if we for the moment at least assume they're going to be correct, we can get a sense as to how these varying sectors of the economy are going to move and where we may expect the greatest amount of motion and where we might get the biggest bang for our buck, so to speak, in terms of identifying a good trade. So to the extent we're able to figure out and forecast and project how the dollar is going to behave in the next few weeks and the next few months, moving on into the end of the year, that'll give us a beat up and a heads up and some edge in terms of the other sectors that are correlated. So this is, what's going on? What are my thoughts on the US dollar? Well, to be honest, I'm not certain. I could look at this from a technical standpoint. Classical chart pattern says, maybe we got a little head and shoulders here. This little left shoulder, the head here, maybe this is the right shoulder. That's one interpretation from a classical perspective. It's just basic tech analysis 101. Another idea says that maybe this little topping area, what I just previously referred to as the head in a classical formation, is the end of a fifth wave when I think of it from a wave standpoint. And maybe everything since this peak in the dollar price is kind of a serpentine type structure, a triangle, a longer term correction. Maybe this is the third wave and we're just in a fourth wave and we're going to have a continued appreciation, at least testing this top again after this kind of triangle. Maybe you have the A, the B, the C, the D. Maybe this is the E of a five-wave triangular structure, and maybe the last 2.5 weeks or so of action here between this little bottom here through yesterday's close represents the start of what would be a fifth wave, which would suggest we can test one of these previous tops, the little resistance areas, either this lower top or at least this, or if it formed perfectly, you'd expect a fifth wave to take out the preceding third, but at least test these obvious zones of resistance. That's another interpretation. Another interpretation would suggest that maybe this is a fifth wave up here again. Maybe this is your A, B, C correction. This is the wave one of a new bull market. This is your correction two. If we allow for the possibility that it technically broke the letter of the law there, you shouldn't have a two that takes out the start of one. But if we, that's kind of a key reversal almost. Notice where the close is. So if we discount the tail, this could be a start of a wave three. And we would expect it to take the market in the next few weeks to higher prices. It's getting off a little slowly, but could be. I can't discount it. So I said all that. I offered 3 or 4 plausible, possible descriptions that, each one of which has a slightly adjusted or differing ramification in terms of what I can expect for dollar prices or the US dollar. Truth be told, I'm not certain. So whenever I reach a point where I run into a wall of information where I don't have clarity of thought and expectation, I need to tip the balance of my analytical scale, so to speak, and the way I typically do it is by incorporating some other tools. I'm not sure from a wave perspective. There are a few, it's kind of like string theory. One of the critiques we hear of the Elliott principle all the time, and I've heard it over the years, and it is sometimes a valid critique, that there are so many possible solutions that are viable, that don't break any rules. You're awash in a sea of solutions, and you end up being more confused than when you were before you started. The challenge by coming up with a plethora of solutions, that's a different but a similarly challenging problem. You don't know which one is the best one, and as such, you're no better off than you were before you started, if you think of it in that sense. But I always tell people, if you can narrow your Elliott solutions down to the 2 or 3 best plausible counts or descriptions, and then just keep them all running in parallel, let's say, in your mind, and then with each passing moment, each passing hour, each passing day of trade, as you see lines traced out on your screen, to the extent the market moves in or hews more closely to a particular wave count or description, you begin to favor that count and to the exclusion of the others, and you put them on the shelf. At any point, if you've got some plan Bs or Cs and it's as backdrop to the extent the market then makes a U-turn or moves in an alternate direction. So I'm not, I'm aware of the challenges implicit with utilizing a model such as Elliott, but I don't allow that to throw the baby out with the bathwater, as they say. I use it as best and extract as much information as I can from it. And again, when I get to that point where I run into the wall, I reach that informational wall of information diminishing returns, I just look at other tools or look for other ways I might see more clearly which particular description or wave count is running the show, or is a responsible catalyst for what's going on with the market. All right, so let's see. All right, I'm not sure. This, if it's a head and shoulders here from a classical thing, then that's certainly bearish, and that correlates with the trend that we saw on a preceding slide, where the commercials have for more than a year now been increasing their net short position. Certainly, the commercial activity, the longer the longer commercials collectively increase their net short position, the more top heavy, the more I can begin to side with the idea that the dollar has been staying too long at the bull party, so to speak, and is overdue for a decline. On the one hand, okay. The other hand, from a pure trend standpoint, again, go back to, if I can move back, look at this. Never, I always tell people in my checklist of technical hierarchies, trend rules the day. The inertia of something, of anything, and in this case a financial system, we call it the US dollar, don't ever underestimate the power of an inertia. Of the trend. I would stack up the trend against 3 or 4 things. Its intrinsic values, it's a multiple of 3 or 4 things against it. It's going to take an awful lot of contraindication type evidence. Divergence from an oscillator. As I said, look at this from 2011 on this chart. It's even longer if I had taken a monthly chart. The decline the increase in the net short position on the part of the commercials. You've got, notice here, as the market's rolling up here from this bottom, or basically this little double bottom in here, notice the open interest, this lavender or purple line, that's telling you that what's responsible for the price incline or increase here is not new buyers. Okay, those are the shorts liquidating. Excuse me, that's the short covering activity there. And so that tends to be a more transient phenomena. Also notice that the volume is decreasing for, off of that top. So prices rising, falling open interest, that's an indication by itself. Certainly not sufficient to make a forecast or a projection, but it's a piece of information suggesting that although we have been rising, there are some indications to suggest the continued appreciation is suspect. Be that as it may. So again, I've got 6 pieces of information telling me the dollar should continue to strengthen on the one hand. On the other hand, I've got an equally but separate and different set of information suggesting we should come. One is bullish, one is bearish, go down and up. Okay, so how do we resolve out of this? Well, let's continue and see if we can find some additional relationships that'll provide added clarity. All right, this is just the daily chart, the same. Rates. I don't have consistency, so I apologize, folks. This is the bond chart. This is the September futures 30-year Treasury bond, ZBU 15 or 5. I just called it rates because it's an indirect way at looking at the cost of money, the bond chart. So we got this, and then I just have a Fibonacci overlay. By the way, folks, this vertical line is just a time target. I place a lot of emphasis on timing. This is I projected time point for the bonds, and again, I'm doing my analysis on the nominal bond price, not the interest rate. You can look at it. It's a question of two sides of the same coin, so to speak. But September 16 is if you can see that, folks, is this vertical line graphically represents the date September 16. So it's what is the significance of this? That simply indicates that I'm projecting a change. One type of change is an outright 180-degree reversal, where a market would stop going up, form a top, and reverse, or vice versa. By the way, this line in no way implicitly indicates the nature, if in fact the market is sensitive, and if this proves in retrospect to be a reliable forecast. In other words, the market changes, let's say, for example, precisely on September 16. something about it changes. Let's say it's a trend reversal. I don't know at this point in time, at this very moment on August 8th, whether it's going to be a top or a bottom. I could reasonably assume if the market's trending up into that, if it keeps doing what it's been doing since this bottom on June 26th, I would expect it to be a top. But again, notice I said if it keeps. I don't know. There could be an interim top somewhere in here in the midst that flips the rotation. Or there could be 2 or 3. I don't know. All I know is that I have, based on the analysis that I do, various models that enable me to project this date, and I have a lot of reliability on that. Okay. So here's a thought. Curious, just as a side note, tangential to this, notice yesterday's action. This is a daily chart. The bonds, nominal bond prices, guys. Okay. Notice we moved up yesterday. And I find that that was kind of, if you're a fundamentalist, which again, I don't start there, but I'm not oblivious and I'm not anti-fundamentals at all. I look at information. Most major investment firms, brokerage, financial institutions, if you know, from the smallest to the largest, in 2015, there is a hybridization where there's a mixture of complementarity. If you know, if I'm working at Goldman Sachs or Morgan Stanley or JP Morgan or Bear Stearns, whatever, you know, on one end of the hallway are the technical people. Down the hallway, just a few doors down, are the fundamentals. Maybe one floor down are the quants. There's a cross-fertilization of ideas in 2015 that there wasn't, you know, 30, 40 years ago. Everything was kept isolated and segregated at that point. Now we realize the benefits. It's kind of like one of my coworkers, Annie Labib, used to say, what's the sound of one hand clapping? So the point he was making is, convergence of all different types of information and relationships and correlations, when in spite of their implicit or intrinsic differences, you see things getting or moving into alignment. That's what, from a probabilistic sense, tends to suggest we're on the right track. Anyway, here's the point I want to make on this slide, or a couple of points. The market moved up in response yesterday to good news. Well, there's just as a quick you know, good news is bad for nominal bond prices. Bad news is good for nominal bond prices. So why did this happen? I was watching the market from an intraday, as a day trader perspective yesterday, and I also had a few sessions talking to students and traders that I mentor and coach and consult, and people were wondering, and the question was asked me on an ongoing basis from yesterday, early morning. I got up at 5:30 and started watching this thing on an intraday chart, you know, looking and trying to dissect the internals of this, what on the daily chart is this one long range here. Why did it move up in response to, what was it, the unemployment report that came out very positive? It was so positive now that from the week before, when the FOMC met, and they were betting that the odds are that the Fed's going to raise rates about 40%, or raise rates in September, and they were placing it at about 40% probable. That was a week ago. Yesterday, it moved up by 12 percentage points. As a result of the unemployment report, they're saying now the swaps market is betting that the Fed is going to raise rates in September. And there's about a 52%. So there's a slight edge to this notion that the Fed is going to raise interest rates come September, sooner rather than later. Okay, for the record, I still maintain we will not see a rate hike until 2016. I'll come back to that in a moment. But here's my more micro immediate point that I was thinking about and mulling over yesterday. Why is it good news? Why did the bonds go up? You would expect, you know, based on this relationship, interest rates rise, remember what I said when we were talking about the first slide, the interconnected slide, intermarket relationship slide. In general, interest rates rise, nominal bond prices decline. Interest rates decline, nominal bond prices rise. So we saw the exact opposite phenomena yesterday. What's going on? What are we having here? Well, notice all of this activity. This is the top that was April 4, if I recall, down to June 26. This represents my view of, and you know, I'm bearish the bonds in the longer term, and I expect that will occur. I still do. I could be wrong, but all of this decline from this top in April 4th, if I recall the exact date, down to June 26, I think that's 6/26, represents the collective view on the part of the market that the Fed is going to raise rates. It's just that, and I believe that this move from this bottom on June 26th through their most recent quote, yesterday's close, is the market's impatience. It's a retracement, just that, but in a broader generic bear market. That's my estimation. Curiously, I put this little overlay of Fibonacci ratios on the screen to indicate it's not coincidence that the market closed right where it did. Notice the 60, this is 61.8, 78.6. That's a Gartley degree of retracement if you're familiar with that. So if you're not, don't worry about it. It simply is when a market, after having moved in a given thrust, so our given thrust for this example is this move from this top right here. It's just an arbitrarily selected top. The market's been coming down. This is just sketchy because it was a liquid. We were at that point in time trading the preceding the June contract earlier in the year, in the spring. But essentially, you can see this top here. We have essentially been coming down from much higher levels for a longer period of time through the bottom that came in on June 26th. Okay, that's the primary trend as I interpret it currently. All of this price action is the retracement. It's just a, what do I call it, a bear market rally, but it's still a bear market. It's a rally within a broader bear market. I surmise at this juncture, given everything I know and think. I do find it curious, though, from a very short-term view of thing, a little myopic here, why the market moved up yesterday. And then I thought about it, and I'll come back because that really is going to guide to a large extent my forecast and projections for on some of the other related sectors. Because it didn't hit me until actually the day before, and then I forgot about it when I was on the phone talking to people yesterday, and then it came back to me kind of around 11:30 in the morning. What's going on here? Why is this market responding possibly favorably? Why is the market bidding up the nominal price of bonds on good news? Doesn't make sense according to normal relationships. If there is some expectation, there's a heightened expectation that the Fed is going to increase the cost of money sooner rather than later. Why would that support nominal bond prices when the normal reaction would be to depress nominal bond prices? So what's at work here? Well, let me just go there, and I don't want to delay it. Let me just tell you, I think the bond market just distrusts our infrastructure, our government, the information, the totality of information arrival. It has for so long been expecting from this move from the top down and the preceding decline in nominal bond prices is the markets. That's a graphic of the expectation, the distillation of the bonds, pricing in or discounting the expected rate hike to come. And that's what all of this decline is about. It's a long-term, big collective bet on the part of the market that the Fed is going to raise rates. The fact that it has not occurred through this point in this rally is the market's response saying, okay, we're getting tired of the Fed and the government calling wolf and just the false alarms. So the frustration, this represents frustration on the part of the market. I can kind of reverse engineer and utilize this bond market as to weed through and to filter the information. This chart tells me why something I mentioned earlier, why I don't believe the Fed's going to raise rates until next year. Although the prevailing narrative that came out, was into the end of the week, and especially on the heels of yesterday's report, is could be as early as September. I don't believe it, and the bond market doesn't believe it because it's rising. It's telling you so that's another way of distilling and through the plethora of information. What's the bonds doing? It's going up. That's indicative of a low or stable interest rate environment. This chart is telling me the bond market does not believe whatever the rhetoric is coming out of the government. And as long as it continues to rise, I'll continue to have confidence in that view. As a trade, from a practical standpoint, if you're depending on your tolerance and the degree to which you seek risk, are you risk neutral, are you risk averse, whatever you stand on the profile of risk and how much you like to take on, how aggressive you are, how conservative you are as a trader. If I'm, park your sell stop to establish a short on the idea that the Fed will sooner rather than later raise rates, you park your sell stop just underneath this Fibonacci level. This is the low end of the Gartley here. Just work your sell stop and hold it there for the longer term, because I believe that will happen. I just believe there could be a delay. Now, on the other hand, if you're an aggressive trader, go along with the idea that this market's going to, if you're very aggressive, move up into the higher region. There's going to, if you believe that the market's not going to see a hike sooner but later in interest rates, buy the bonds, the nominal bonds, get long in your one way or the other. If you are, if you believe that, but you think you're a little afraid to do that, you're gun shy, so to speak, put your buy stop above the upper range of the Gartley, above the 78.6 level. Here's my time target, September 16. Again, I utilize that as a anchor of time. Markets are on a, we typically evaluate price action on a two-dimensional plane, time and price. Time is always the neglected axis. Most traders don't look at it. It's kind of acts as my concierge, if you will, to try and interpret. It's my tour guide. Doesn't tell me everything, but it adds to my price analysis. Price is certainly a lot easier for most of us to figure out, and direction. But vis-a-vis Gann and people like him, a market's going to do what it's going to do only when its time has come. So if I don't know what the heck is going on, wait till we get to here and then see what the market's doing as it runs into this point in time, and then expect an outright reversal. Sometimes you'll get it, sometimes it's a consolidation. But use that as an anchor or to kind of ground you to get some reference by which you can evaluate the chart and or the information. But in a very clear way, to the extent one doesn't understand what the dollar is going to do or any other correlated sectors or specific markets, follow this chart and it will tell you, at least it'll read the Fed for you. It'll cut through the rhetoric and the equivocation on the part of Janet Yellen and the FOMs and the bank governors, and try and figure, as long as this continues to rise, it's telling you we're going to push that rate hike further and further out into the future. When you begin to see a resumption of the primary trend that clearly on this chart began in April and down through here, that's the resumption of the short bet, and that the market perceives that we're going to see the primary catalyst for that, and that is the rate hike. Okay, I'll come back to that. Here is something for the moment that I think will enable just specific correlations, okay? And this refers, if bonds let me start on this side. If bonds continue to go up, as the previous slide is indicating, what we've been doing off of that bottom June 26, let's just figure out some corresponding relationships that I think will be valid for the next few weeks, for the next few months, and the specificity of the time period, the run time for each of these sectors, I have worked out with my timing. So I've got a couple of things. I've got these intermarket correlations that I can then complement or utilize as a complement to my timing, and that the time points that I've projected are specific to each market, as you'll see on some of the exhibits that I have coming up. So for example, I'll start, when I had written this on my notes, it kind of got transcribed, so it doesn't matter, but if bonds continue to rise, okay, I expect dollar prices. Remember I was saying the first slide that showed the intermarket connections was working from the premise or vantage point of the dollar being the ultimate driver. Well, why did I just arbitrarily pick the dollar? Because again, working off of that notion qualitatively, if a country or a nation state or a sovereign entity issued stock, its currency would be its stock. So it serves as a primary proxy for the state of affairs of an entity, such as a nation or a sovereign entity, such as a country. So if bonds rise, why? Based on the preceding slide, I said that would be an indication that the bond market, the nominal price of bonds, again, not interest rates, or they are one and the same, but I'm going to speak of it in terms of nominal bond prices. If they go up, I expected that's dollar chart we were looking at when we were trying to figure out and discern and dissect and differentiate one wave description for the US dollar versus another. I got a classical pattern of head and shoulders, which is bearish. I've got one wave count, a few wave counts that are bullish. I've got some that are bearish. Which one do you think, if you can't differentiate on that alone. Look outside of that. Well, if the bonds continue to rise, they might be rising on a continued delayed in a hike. If the bank, the central bank, were to raise rates, that would tend to strengthen the dollar. To the extent they put it off, the dollar will languish, and so I expect nominal dollar values to decline. And then based on that intermarket, if dollar goes down, that oil's priced in U.S. dollars. So far has been historically, that will tend to lift commodities in general, oil in specific. What's been going on in oil is in a few slides you'll see. It's been declining for years now, as you'll see. And falling dollar prices, rising metals, stock market falling. If we maintain if nominal bond prices rise, lower corporate costs, lower margins, operating margins, higher profit margins, stocks rise. So these are relationships. I'm thinking from the perspective of the bonds. Okay. On the other hand, if bonds all of a sudden resume going down, that would be because the bond market collectively is interpreting that the Fed, the bank, is more likely to have a rate hike, and that in turn, the rate hike lowers monetary supply. Each dollar in circulation acquires greater intrinsic value. Dollar values increase. Oil, commodities in general are priced in dollars, so rising dollar, falling or depressed oil prices. We continue to see the slide in energy. Okay, metals, the same thing. And there's an argument for each of these, as you'll see. Rising interest rates raises or causes delays in corporate borrowing, impinges on corporate borrowing and capacity to expand, cuts into profit margins, stocks go down. So these are the relationships that I expect will guide me intermarket connections. And then I'm going to add this to my timing to get more precise situations that I think will transform into some good trades. This is the S&P, Exhibit A. Here's some of the specificity I was referring to. This is a time point, my next time target that I projected for stocks. I use the S&P. You could geometrically, whether it's the Dow, the NASDAQ, the Russell, the SPY, more or less 70% of the time there's correlation. Yes, there are going to be excursions where one index, one broad market equity sector diverges from another, but approximately 70% of the time, whether you're looking at the S&P or the Dow or the NASDAQ, they're more or less going to be geometrically the same. They're not always perfectly in sync, but more often than not they are. So these projected time targets are universally applicable to the aforementioned indices, whether it's the S&P, the NASDAQ, the Russell, the Dow, etc. All right, August 19. That's my next projected time point for the stocks. What does that mean? I don't know. Initially, a few weeks ago, the last time I project, I'm long in S&P, long from 2084 or 2054, which we closed yesterday about 2074. So I'm up about 20 points. You know, in retrospect, I was up when we were at over 21 when we were running into that. I got long about a couple of months ago. It's a longer term play, but I'm still up. In light of the last few weeks of price action, I may change my view. Previously, when I got long, I was expecting the market would move up into this time point. Now, in light of this, when conditions change, I must adjust. I can't buck the trend. And a pure trend rules the day constantly. At least it should, in my estimation, as a trader, and even from an analytical standpoint. So it's conceivable, one plausible scenario is that the market might continue to move lower into my next projected time point, August 19. I've worked out a subsequent time point for the stock sector, September 22nd. It's conceivable, let's say hypothetically, if stocks were to continue to drift lower into August 19, which is what? That's about a week and a half from now, right? It's not next Wednesday, it's the following Wednesday. I just looked at the calendar. 8/19. Now if this bottom right here holds, that'll be good. That's very positive. Traders were asking me all day for the last few days, Glenn, what are you going to do with your long position? Well, if we take out this bottom right here, that's not good for long positions from a practical standpoint if you're not already out based on monetary stops and so forth. And it depends how you're positioned. That's a separate issue, albeit important, but more importantly, you work out the theory and the projection, then you figure out your corresponding strategy that meets and fits and is commensurate with your particulars of who you are as a trader. But again, I'm not sure. You know, the data that's coming out is this is a schizophrenic market. From this long-term bottom, October 15, 2014, through today, clearly a bull market, a succession from, again, this is the longer term back in October, this was on October 15, that bottom here, through August 8, 2015, August 7, this was yesterday's close, this is a daily chart of the September S&P, higher and higher tops and higher bottoms, characteristic feature and peculiar to a rising bull market. I still think we are in a bull market. One plausible scenario is that we're in a phase here of retracement from this top right here. That was that? I forgot the day on that top. But this is a perfect double top. This top, I remember this is May 19th, the highest point, which is exactly in price terms basis this contract, the September, exactly the same. It was 21, 25, or 26 or something. I forgot the actual top, but that's a perfect double top. This is May 19th. This is the more recent top in July, I think. Okay. I believe, you know, it's possible we could move lower into the next week and a half, into not this coming Wednesday, the following, 8/19, and then find a base of support, which currently I don't think will take this out. It could. We'll see. It either will or it won't. But I think once the market stops coming down, if that's what happens, if it occurs kind of on or around this proximal to this time target that I projected, 8/19, that would suggest the market would be moving up into the next projected time point, which I've worked out to be September 22nd. If that were the case, I would expect a higher high. The market will be somewhere off the screen here. I expect that this double top, this top that came in July, the same top high, all-time high of the stock market, which came in initially in May 19th. That's the actual day, May 19th, for this index. Different indices, it may be slightly different, plus or minus around the same. But I expect if that scenario were to play out, by September 22nd, we'd be at a new all-time high in the broader stock market. All right. Now that might, I don't know, that might be the end of the generic bull market. Not certain. I'm just saying I have some evidence to suggest. I don't think August 19th, even if we turn around prior to 8/19, start moving up, and the 8/19 point in time turns out to be a top, I don't think that's the end of the bull market. I do have, in the total of everything I am considering factoring in, it's more plausible based on intermarket and technical factors and other things I look at in the total consideration and resolution of things. The September projected time point could more likely correspond with the end of a generic bull and correspondingly the onset of a bear market. I don't think 8/19 is going to be that point. I'm not certain 9/22 is, but I have more evidence. There are more things that would suggest it could be, whatever 8/19 is. Okay, so this is, so right now, again, my current positioning in stocks is long. Specific, I am in the E-mini S&P. I've been long for a while now and thinking of it as a position trade at 2054. We take out this bottom right here. That is your support. If you're not already out of a long position, get out. The only exception being if you're in options, you know, you got a long call position or some long position in an option spread or something that is hedged, and you can weather the path and the volatility so that we're expecting a new high. Because I do expect for the majority, you know, for the next few months going forward, I expect further appreciation in the broader stock market. So based on a large set of data, long-term cyclical data, the fifth year of every decennial tends to be a year of appreciation in equities, going back for more, you know, close to 200 years. So there's cyclical, seasonal components that are, to a large extent, prompting my bullish view for stocks for the remainder of this year. Okay, Exhibit B. Precious metal sector. This is a daily gold, August gold chart. You can see we've been coming down on the metals for a few years. This is just a recent. This is just showing through going back through the fall of last year, 2014. Clearly from this top. What's interesting? Here's my next time point for for gold. Okay, now I want to 922 is the second projected, is the not the most proximal time point for stocks that I've worked out. 819, that's not this coming Wednesday again, but the following Wednesday, and then subsequent to that, September 22nd. Interesting possible correlation here in gold. September 11th, obviously it's a curious date. I didn't cherry pick it. It just worked out with I derived that date through a series of different models that I utilized to project and enable me to forecast when I expect in the future a market to change. Again, when I do this, it doesn't tell me if it's going to be a top or a bottom. It just tells trend reversal is in the offing on or around that point. You can see clearly the long-term trend in metals in gold, silver, platinum, etc. has been down for years. All right, we have a little triangular structure. I should have delineated that graphically, but you can see that's very fourth wave-like for those of you who are aficionados of Elliott, but if you aren't, doesn't matter. It's just consolidation. Here, this bottom right here, the lowest point on the screen, July 24. What I don't show on this screen, and I didn't put it in, I think maybe in the next slide on silver I did, but for suffice it to say, I had a time target in the metal sector and for gold in particular, July 31st, which was last Friday, a week ago from yesterday. The preceding, a week last Friday, or a week from yesterday. July 31st, which I believe was this day right here, if you can see the tip of my little pointer. This bottom, the lowest point on the screen, was the preceding Friday, July 24. I went long in silver the week before, not this week, like in just right after, the week after, like it was July 28th, I believe. 3 days before my projected time point of July 31st. It was like Tuesday, I think I went long in silver, which is essentially long in gold, one and the same. They're highly correlated. A few days before my theoretical projected time target of July 31st, which was last Friday, a week ago yesterday. Well, I did that because there was some evidence to suggest to me the possibility that maybe my theoretical time point, July 31st, was about a week late, and that I was giving more credence to the idea that this was the bottom and then we were going to reverse to the upside. Well, we have, to some extent, albeit not in a significant way thus far at least, moved up off of those bottoms, either from the bottom of July 31st or the more obvious bottom, the one on July 24. And so you can see gold prices settled yesterday. I think we're around 1094 and change, 1,094 per ounce, just under 1,100 per ounce here. Okay, so I'm bullish gold. So that's exhibit B, so to speak. This is just a silver saying here's the July 31st, same thing. Just essentially it's applicable to both gold and silver. That's the day I went long, right? I went long a few days, like on the 28th, because I was concerned. Same bottom, July 24. My theoretical projection was for July 31st. It actually tried to kind of come down. It'll have a little, almost a semblance of a double bottom. We settled in silver yesterday at 1482. I'm long from 1465 on average, basically. So far, so good. We'll see. That's exhibit B, for silver. A and B for silver, or B for gold and silver. They're both B. And now I want to revisit the slide and think of it, because I'm still trying to figure out where the best trades are going forth. Right now, oh, by the way, as a practical situation, as a position trade, if you're not positioned long in silver, by the way, again, let me think here. Let me see or clarify this. This is my time point for the metals, July 31st. Even if I mentioned to someone yesterday, because they said, you have a better formation, a little continuation triangle here. And so the trend in the metals clearly is down. Someone said, Glenn, why would you, when I've taught them, continuation triangles tend to correlate 70% of the time with just that, continuation of what it was the market was doing. Why did I go long? As opposed to expecting this to be the type of continuation reversal. Why didn't I go short? Well, here's my thought. If we take out this bottom of July 24, I'll SAR, I'll stop and reverse, get out of my long position in silver, and just I'll have a sell stop to wipe me out, but the magnitude, the number of positions or contracts or lots in this case would be an amount greater than my current long position so as to create a net short position. The market will tell. Sometimes I don't get it quite right on the direction. Initially, you have to test the water. But one thing was I had over 90% reliable expectation that the market would respect on or about July 31st a change. And so if I'm wrong, though so far I'm right, but if I'm proved to be wrong, certainly not any later than taking out of this bottom. Allow that bottom of support to serve as a contingency on the one hand. Or if you think you're if we're gonna go up and you're on the sidelines, you want to play it conservatively, draw a little trend line connecting these tops right here like I should have, one side of the triangle, connect this bottom with that, and that's your triangle. We break down below the lower side, go short, you break out above the upper side, you go long. That's how you do it. If you want to allow the market to show a few more of its performance cards, if you will, for you, so you decrease the probability of jeopardizing your capital. Anyway, we didn't have quite as good a triangular structure in the silver. Nevertheless, I traded silver because it's more volatile and get more bang for the buck, and we are moving up. And my point in all of this is saying is even if you're not positioned one way or the other in silver, it's still not too late. Again, I'm thinking of this as a longer term play. We have been coming down in the precious metal sector for 2.5, 3 years. Even to the extent there is an asymmetrical, even if we don't have a proportional response, for every action there's an equal and opposite reaction, even if, Newton's law falls short in the real world, there's some, adjustment to it, and we don't get as much, it's not an equal 50-50, it's not a perfect democracy in terms of amount of time that the market moves and the corresponding distance it travels. If I travel 1/4 of the distance, to the upside in terms of a reversal, let's say, as we had coming down, there's still a tremendous percentage return opportunity in the metals right now. And so in terms of probable expected degrees of volatility and the corresponding distance of travel, a market, these particular markets can make very high probabilities here for extracting large percentage returns in these trades right now. And will continue to be so moving out for the next few weeks. Again, my most recent time point, I didn't put it on the gold chart, I put it on the silver, July 31st. My next one, I should have projected it. Let's see, did I do it on the gold? No, I didn't. Yes, I did. 9/11. I put it the future. So my next relevant, so my run time, however, whenever, what direction, whatever you get positioned in gold or silver, platinum, well, not platinum, it's a little different, but gold and silver, either one. Whatever market and however you get positioned, once the trend is established, I expect it will continue more or less persistent and continue to, its runtime will be from the time, from now until September 11. Now remember, preceding slide, I find it's interesting, 9/11, 9/22, it's not exactly the same, but it's 11 days difference. That's an interesting correlation. There are about, just a week or 2 weeks of trading days, 11 days actual calendar days separated. Very interesting. Metals, my next predicted time point, September 11, curious date in and of itself. My stock projected time point, 9/22. Interesting. They tend to be inverse. Money comes out of equities for whatever reason. 50, 60 years ago, it used to immediately go into metals. And then the downside of that is it's there, hard metals are not interest bearing, so it's not generating rental income, so to speak. But now, with the advent of the bond market, money immediately leaves the stock market. Its first deposit way station is the bond market. And then if things really get severe in terms of panic in the streets, so to speak, with declining, the velocity of decline in stocks, then you find an overflow or just a direct route. You bypass the bonds and go directly to metals when people really get scared and there's a mass capital flow out of stocks. Nevertheless, that's how I'm positioned. I'm currently long in the metals. If you're a little hesitant, wait for a break above that trend line in gold right here to the up if you want to go long. If it works out that I'm wrong, wait for a break below that ascending trend line if you want to go short, and expect that it will continue to move once you break either one of those two sides of that triangle through September 11 or thereabout. And that gives you a sense of the run time of that position. And how, if you're an options trader, you can get a sense as to how far out you should select the expiries. All right, this is the silver chart. Moving on. Okay, I want to utilize oil because there's some very particular and interesting wave structure that I want to correlate with a very fine point of Mr. Elliott's research in his original papers that generates a 97% probability. 97% on my money, I'm going to take that bet all the time. Doesn't always happen, but when it does, or even if you approach that, it's a very high probability. I should have put an asterisk by oil because oil certainly, if any, one of the very best trade I did this year, we got short oil at 66.10 and sold it down to 51, and then we got out and then resold it. But from a theoretical standpoint, let's focus on oil. Allow oil to give us some key to clarify what we expect to happen in the other sectors. Okay, what had happened? We hit new lows in oil for the last few years here, or for the last year, as you'll see on the next chart. But let's focus on oil. So it's either going to go, we're either going to continue to slide. You know, in the October WTI contract, we settled near the low at 44,036 cents. I had projected months at last year, at the final quarter of 2014, we could see $47 oil, possibly $45. Well, we settled yesterday at below $45. I think we could drop possibly another $2 to $3. I don't see $35 oil. I could be wrong. I just don't see it based on everything I'm looking at. But I don't know that the drop is over. I could see $40, possibly $39 oil in the next few weeks, if not months. Certainly. But let's see. It's either going to, the trend clearly augurs for continued depreciation and declines in oil prices. But I've got my next time point coming in for the oil market. My last one was July 14. My next one is October 6th. So that's relatively distant. That's not so proximal. But let's see. If oil continues to decline, then looking at these other relationships, that would, I expect, that gives me some insight as to what I can expect looking at it from this perspective, allowing oil to be the driver of these other sectors of the economy. That would correlate with a continued appreciation of U.S. currency. Okay. If oil finds support and reverses, that might mark the top in the dollar. You see, so I'm bearish the bonds. At least for the next few weeks. So let's just allow this slide and with a focus on imagine that oil to be the driver of these other market sectors. If oil continues to slide, I expect the dollar to continue to rise, bonds ultimately to continue to drop, which would mean that the Fed is more likely going to raise rates sooner rather than later, maybe September. On the other hand, oil finds support, bonds continue to rise. That's saying, again, the bond is calling the bluff of the Fed. They're not going to raise rates until possibly next year. So let's see. Let's look at oil and see what I'm referring to in particular that it may give me some insight to the extent I can figure out oil and what it's going to do and how it's going to do it and when it's going to do it. I may figure out I've got the others locked in, assuming or working on the assumption that these correlations are valid. All right, this is long-term oil chart. This is a slide I presented 16 months ago, showing from 2009. It's a weekly continuation through. This is ended 16 months ago. This is a slide I presented in a presentation just not quite a year and a half ago. Notice, look at these all-time highs here. Over close to $115 a barrel oil. Ended up. This is a year ago or 16 months ago. This was last April or so. We're still over $100 barrel oil. Okay, so remember that. Look at the chart. Look at this long-term triangular A, B, C, D somewhere in here. One of these peaks. E, maybe this is E, and this moved up into possibly a new bull market, but maybe it was truncated. Couldn't make it any higher. But still over $100 barrel oil a year, just 16 months ago. Fast forward to the present. This is a daily chart printed out yesterday. The crude oil contract for delivery in October. Daily chart, October oil. This is the top right here on that's May 6th, right? See the calendar down here, folks? May 6th top. Here's a plausible wave count. Wave 1 coming down, more recent action here. We've been coming down, remember, preceding slide kind of picks up. This is a year ago, 16 months ago, to be April of 2014. I didn't show all of this, but you know, it's from up here in the upper left-hand corner of my screen. It continued to slide from, again, back at 16 months ago, we were over over $110 a barrel, near approached in the first quarter of last year, January, February, we were close to 115, 100, excuse me, 100 and, what is that, near $105 barrel oil. Now, 16 months later, we're down near $40 a barrel. Okay, here's a wave count more recently. 1, correction 2, here's your 3. That 3 came in on the day of July 7. And here's what's important, and because it highlights this very specific relationship. This is the 4. That top came in on July 10th. I didn't mark the dates because it's just too busy a chart. This is your 4. So here's the point I want to mention. If this is the daily oil chart, we've been sliding. We went from over $100 a barrel oil, and in less than a year and a half, we're now trading close, getting close to running into $40 barrel oil. Notice the rising volume, supportive of the trend, suggests correlation of persistency of trend. The trend itself, based on the inertia, suggests we can expect further declines in energy prices. Oil, the volume, new sellers coming in, rising open interest, higher volume, more trades, it suggests that the momentum is feeding on itself, and as such, by that, it would suggest for lower prices are in the offing. Okay. However, my wave count, if this top right here, which the date is July, this bottom on what I marked wave 3 is July 7. 2 days later, or whatever, or 3 days later, July 10th is what I was number 4, the end of correction 4. Everything from this 4th is what I expect to be a 5th wave. A finer point of Elliott analysis is when you have a succession of nested 5th waves, 5 in fact to be specific, a 5th wave embedded within another larger degree 5th wave, still within a larger 5th wave, within a larger 5th wave, within a larger 5th wave. I just counted out 5 5th waves embedded or nested, one within another. 97% of the time, the market will reach a terminal point and will reverse. Now, that doesn't happen all the time. When it does, it's a strong 97% based on whatever calculations and research Ralph Nelson did, the market will reverse. And that, in fact, is the primary practical objective of the wave principle, to find and enable you to locate a dependable 5th wave ending point. Because when the market reaches that 5th wave, and then that particular 5th wave is the 5th, a smaller nested 5th wave within a larger 5th, which itself was nested within a still larger 5th, which is nested within a larger 5th, which is still nested within a larger 5th. Again, 5 degrees of 5ths. A 5th within a 5th, within a 5th, within a 5th, within a 5th. 97% of the time you found the market would turn. Well, so based on my analysis, if this top right here, this little point that above which the 4 is representing, marking the end of correction 4, everything to the right is a 5th, bringing us through yesterday's close. That's a particular 5th wave, 1 degree. This is the next slide. I wish I could have had enough space. This is the top here. This is the very same July. This is the, let me back up. I should back to the previous slide so you can kind of get this. Again, this date right here, although it's not marked, represents July 10. This is the July 10. That's everything since is a 5th. This is the 1 of the 5th, the 2 of the 5th, the 3 of the 5th, the 4 of the 5th. This is a 5th of a 5th. Curious. So this date, this little date in here is July 29. Right here, that little top here. That's the 5th of a 5th. Starting on the day of July 29. That brings me to this chart. Here's the July 29 5th. This is that little July 28 bottom right here. This is an hourly chart. The preceding slide was a daily chart. Okay, this is the, okay, so if this, from this top, July 10th, or July 10th is the start of a 5th wave. Everything to the, this would be hypothetically my projection as to where I might expect that particular 5th wave that began on the top of 7/10, July 10th, to end. If it started here on 7/10, somewhere out here in time space, I would project it theoretically to end. and that's a particular fifth wave. If it is a fifth wave, theoretically there should be 5 little waves internal or inside of it. Well, I can see even on the daily chart, this is the 1, this is the 2, this is your 3. This little bottom here is the date of July 7, and then the 2 days later is July 10th, or 3 days later. That's my fifth, and that marks the onset of the internal fifth of this larger fifth. That's one to a fifth within a fifth. We're showing the progression of embeddings or nestings of fifths. And this is that top right here, marking the end of wave 4, which is by one and the same as the hourly chart. This is the July 29 top right here. If you can see the calendar on the hourly, each vertical bar represents 1 hour of range of price action. That's the top. And so everything to the right of this number 4 is a fifth, a little fifth within a larger fifth. It's the fifth of a fifth. Okay, well, if it is a fifth of a fifth, there should be 5 little waves within that. Here's your 1, here's your 2, this is your 3, here's your third fifth. This from this point right here. This is your little fifth of a fifth of a fifth. And the phone is ringing, but disregard that. All right, so that's the fifth of a fifth of a fifth. And let me just let me stop that noise so I can focus and complete this here. All right. Anyway, doesn't want to. It'll stop in a second, folks. But that's the fifth of the fifth of the fifth. And let's move to the next slide. And this would be. Let me just back it up. I should have. This is. Notice the dates here. This is the 7th to the 8th here of. This is of August now. This is back in July. July 29. That's the 5th of the 5th. And then we have a fifth. This fifth that begins here between August 5th and August 6th, that's your third fifth. If that's a fifth, there should be a fifth within 5 waves within that. So let's break it down to the 10-minute chart now. Here's your August 7th. This is the 10-minute chart showing yesterday's action and the preceding day. These are 5 nested fifths. This fifth that began possibly, or just this fifth, this is the 4th fifth, this is the 5th fifth, it may still have more to go. We may take out this bottom here, we may not. The question is, or the point that I'm bringing out with these slides is, I have identified structure that does suggest the possibility of 5 fifths embedded or nested one within another. That certainly augurs for the idea that if we are not already at a bottom in energy prices, or oil in particular, at $44 and change per barrel, we're probably near it. On this particular structure, way in which the market has moved and the internal structure that has resulted, it does match up so far, at least, with the possibility that, again, if we're not at the end or if the market hasn't found support, the odds are likely that we're approaching such. This action could take this out. We could still be in this final fifth, and that would allow for the possibility of even further declines. That's why I said 2 minutes ago, possible I could see another $2 or $3 of oil price depreciation. But again, we're at $44. I don't see the market trading much lower than $40, $39. It's possible that this final fifth wave, that's 5 waves or 5 levels down, could still be forming. And that could be a theoretical argument or reason that would facilitate additional decline in offering the price down even further. But beyond that, I am hard-pressed. Again, 97% of the time, when you have this internal structure, you see the market reverse. So on that relationship, going back to our long-term, assuming that should occur sooner rather than later, where the oil price starts increasing, what does that tell me about the bond market? It's suggesting that the bonds, or that in reverse engineering this tells me something about what I can expect in terms of the policy from our central bank, that they're going to delay the rate hike, as I mentioned at the outset, and as such, nominal bond prices will continue to rise. Why? Absent an increase in a rate hike. At the current level, they're not lowering any rates, but they're just moving. The bond market is just going to move up. Dollar will sooner rather than later reach that top, consistent with the commercial activity in the US dollar. Metals will rise, stocks will rise, consistent with my longer term view for equities as well. Assuming we hit this, assuming that sooner rather than later we hit the bottom in oil and we see a commensurate reversal, as the internal structure of the energy or oil market does suggest. That would cause me to favor this series of relationships on the right side of this screen, assuming we see that, based on this embedded degrees of a fifth of a fifth of a fifth of a fifth of a fifth. All right, completely different sector. For those of you who are commodity traders focused on agricultural or the agro markets, soybeans. One of the second best, or the second best or most profitable return campaign we waged this year was in beans, and to a large extent. Now, interestingly enough, beans, you might think an agricultural market is in no way, related to the stocks or the financial sector. Well, beans, soybeans in particular, are curiously have an interesting correlation with inflation, and in turn, the Swiss franc of all markets. There's a very interesting relationship between soybean prices, the level of inflation or GDP, and Swiss franc. The point of this webinar is not to get into that. Suffice it to say, the second best trade after the short we did in oil was my long in beans. I projected this line June 16th. I purposely offset it. This is this long bar, if you can see that, just to the left of this vertical blue line. The vertical blue line indicates my time projection of June 16th, which I'd probably done at some point weeks in advance, and then my subsequent time target, July 2nd, which is also offset so you can see the price action, the actual bars, if you can, assuming it's not so small you can't see it. But the actual bottom came in, I was a day late in both cases. That's an amazing amount of accuracy. I'm not tooting my own horn, I'm tooting the horn of the confluence of models that I use that enable and facilitate the high degree of accuracy. Sometimes it's perfectly precise. In this case, it was 1 day off, so there's a consistency in my inaccuracy, even though the inaccuracy was 1 day to the extent of the what the models generated. The point is this: we got long June 16th to a large extent promulgated and on the heels of my expecting a reversal. The reversal came in on June 15th. That's the lowest point on this chart. I wrote it up to the date at which I had my subsequent time target, July 2nd. The actual top came in July 1st. It's that day right there. So we caught that move. That was over $5,600 per contract in about a 2-week period in appreciation in the bean contract. You can see now I did not play this move down. I wish I had. Wave count here. If we discount this little tail here, 1. This is your 1, this is your 2. I know it broke a rule for those of you who are a stickler. I am not unaware of that. This would be your 3. Now, this bottom right here, if you can see, everything from here through where we are closed yesterday is either a 4, this is what's called an irregular correction, this is your retrending B wave, or this is the 4, this is the 5, and then this is a new wave 1. This is my projected time target for beans moving out into the future. When is it? August 18. That is that's 10 days from now, 10 calendar days. It's not next Tuesday, but it's the following Tuesday, curiously enough. So if I'm an aggressive trader, I had a lesser, I didn't put it on the chart because I had a time target August 4 in the soybeans, but I only had about 65% probability of confidence in that. This one I have, over 80% that the market will turn on or around August 18. Thus far, if I had responded, and some of the people that I consult did go long in the beans, and so far you're doing well in response to the August 4 time point that I did not put on this screen. But in any case, if you do nothing as a trade, and you just wait till if the market does whatever it does, if it continues to persist moving higher into August 18, I'll be looking to go short beans again. If, on the other hand, whatever the market's doing as we get closer, depending on where we are, and I don't quite have clarity on that wave count, there's a couple of possibilities as I just mentioned. Either this bottom right here is the end of a wave 3, and everything through yesterday's close is a correction 4, and maybe we're still in it. If not, if that wave count is accurate, I'd expect the market to soon stop going up and come down into my next time target, August 18, and then I'll be looking to go long. I would either go short in the next few sessions and then look to get out of my short and possibly reverse on or around August 18, or if this is the 5th, this is a new wave 1 possibly, you see, and then I expect it maybe to move higher into August for the next, through the, not this coming Tuesday, the following Tuesday. So that's another, for those who are interested in the agricultural sector situation, you either have a trade right now where I'd be going long, or if you're more conservative, wait till we get proximal to 818, depending on the direction of trend, look to trade the reversal. If we continue to move higher into August 18, that would suggest that the lowest point right here is the end of a 5th. You're trading the formation of a wave 1. If, however, we move down, it's possible, this could still be a 1, and then the down move would be a 2. As long as we don't take this out, then I'd be looking on or around 818 to go long again, and what would be the third wave? That would be a particularly advantageous portion of a market cycle to trade. Alternatively, this entire move from this bottom here to where we are, yesterday's close, could be a 4th wave, in which case I'd probably expect sooner, the market to go down again. If you're not certain as to the count, wait till we get close to here. This will improve the odds of your trade working out in a profitable manner. All right. So, folks, again, just a quick recap, just to indicate what my thoughts are as a synopsis of wrap-up. Allowing oil, given the succession of 5th waves that I've identified from my technical analysis, to rule the day, assuming that is correct, and that the oil price slide sooner rather than later ends, I would expect oil sooner rather than later. We've got a trade lining up to look to go long in oil soon. Once I get confirmation of that, I'll identify zones of overhead resistance above which I'll probably go long. And I expect the bonds will continue to rise because essentially the nominal bond price is forecasting and projecting that the Fed is not going to anytime soon raise rates. There's going to be a delay with which the Fed raises that rates. As I've said qualitatively for other factors, I don't expect that will occur until 2016. That in turn would create more likely a top in the dollar and lend itself to continued appreciation in the metals, continued appreciation in stocks. That's the scenario that I'm biased towards leaning and trading on right now. If we see a price action, if I'm wrong, we break down below $39 oil, then I've got to acquiesce and capitulate to what's going on. I'm not gonna stick and be attached so strongly to a particular view that I allow my account to be equity. I'm more interested in the funds and the return on investment. So if we start to see price action that clearly and objectively indicates further slides are going to persist in energy prices, then this set of relationships, that would probably indicate sooner we could very well get the rate hike sooner, possibly in September. I would resume and expect to look for opportunities to short the bonds. That would be commensurate with continued appreciation in the dollar, and I wouldn't be surprised to see a reversal in the metals and a reversal in stocks. You see, so I'm essentially allowing, in this case, oil in conjunction with the bonds, these relationships, and we've got some tremendous opportunities in terms of trades that are presenting in the next few sessions, in the next few weeks, and certainly in the next few months to come. All right, that concludes it. And I somehow, someone's asked about a S&P. Let's just see quickly before I do the little commercial here. All right. Well, I should have, don't worry, I'll quickly, I think these are pretty straightforward relationships that I can address very quickly, and if not, you'll know how to contact us at least indirectly. So let's see, sound is good. Let's quickly address these questions, folks. So I addressed that. I think Mike had asked, was when I had the slides showing rates, that I should have stated explicitly, it's just the nominal bond price. There's an inverse relationship. I'm oversimplifying, but more or less inverse relationship. Interest rates go up, nominal bond prices decline. Interest rates decline, nominal bond prices go up. That's one relationship. Okay. And so the charts I was referring to when I said rates or bonds are, in either case, it's referring to the bond, not the interest rate. Okay. Let's see, what's this? Price, yeah. Price with respect to increasing, decreasing. Yes. Correlation slide. Yes, Mike. Slide 1. Yes. Okay. Where did September 16 come from? 9-6. I know what. Whoever, Mike, you're asking. That's good question. You're referring to my projection for my next time point for the bond market. That's a different webinar. That's an entirely different set of relationships. It's a very good question, and I did not have time to make that explicit. My area of research is market timing. Long story short, when I was getting started at Merrill Lynch at 25 years old, I started as a broker. A guy in our research department handed a book to me and said, "Glenn, this is market timing." And it had to do with cycles. He said, every stock market activity, all financial market activity to a large extent is a reflection of human activity. If you think about human activity day to day, a large percentage of our daily activity is a direct consequence and function of the Earth revolving on its cycle, 24 hours, 360 degrees in its rotation. It made perfect sense to me. That was how I don't have time left, but I began at that point, again, almost 34 years ago, to see the importance in how integral market timing was. As I alluded to I glossed over it at the beginning of today's presentation. I said, the horizontal dimension, that is time, is the neglected axis of market motion. Less than 5% of traders in the world apply or utilize market timing. The very best traders of past, people like W.D. Gann, Jensen, J.P. Morgan. Morgan is famously quoted as saying, if you want to make millions, just use price. If you want to generate billions from your speculation, you must incorporate market timing. The quick answer to your question is, Mike, and I've done webinars on this numerous over the years since I've been doing them, and I spend a lot of time, again, in my research, generating time points. It's through there are various models. There's no one technique. There's cyclical analysis, there's seasonality, there are geometric projections that I use, there are numerical relationships that I exploit to generate time targets. No one technique, similar to price, by the way, do I have perfect confidence in. There's no technique for be it price or time that I feel is perfect. As such, I typically utilize a few, 3 or 4 very, very different models that are designed specifically to enable me to project when in the future, when in time, I expect a market to turn. By the way, I can do this for short-term day trading. I just do everything in terms of minutes typically there. I'm calibrating on a time window within which is germane to the window of time that I expect to be in a position, or I can do it long-term, in which case I do it on a daily chart, weekly, monthly, etc. So again, I'm answering your question without explicitly answering it because there's just not time sufficient, but suffice it to say, there are many ideas, both geometric, numerical, seasonal, cyclical. There's just within the realm of seasonal or cycles. There are many, many types of cycles. There are price cycles, there are volatility cycles, there are astro or planetary cycles, there's terrestrial cycles, there's all sorts of cyclical types, subsets of cyclical models that are utilized to enable markets or traders and analysts who utilize market timing to generate their time targets. So it turned out that one of the dates I projected for the bond market in particular was September 16th. So I use a set of different things. When I get convergences, when I get 3 or 4 different models that I utilize that I've worked with over the years that enable me to, and I know I have a fair accuracy historically track record for them, when I have different models lining up on the same date or nearly the same date, my typical margin of acceptable error is 3 units of time, so 3 days. If I get September 16th from one technique and another technique gives me September 18th, essentially I consider that a hit, a time cluster is what it's referred to, and I have confidence in it, and it grows the more hits I get. So in principle, that's how I got that. Some of the traders that I work with and teach in our mentoring and so forth who are interested in learning how to do this, we go into the detail and I explain and teach how to do these things. Is September 16th a time fib or a future news date? It might be a future news date. If it is, I don't know. Here's the case where I can make a point. Years ago when I started, I traded off of news. Very often people will call me and tell me the date of a report. Like I happened to read early this morning prior to coming with you guys, the PPI comes out later this week. I heard something, but that was just happenstance and ad hoc. Years ago I was very disciplined and an orderly and systematic in terms of what news and what reports. You can't be in a business and you'd have to be under a rock somewhere to not know the Fed's going to speak on a certain day, unless you're just completely purposely. And to some extent, the purist technician part of me, rarely, when I was in my 20s getting started, I was prodigious in the amount of stuff I would read and pay attention to. I was, even before the internet, I was reading every piece of literature, IBD, well, even before IBD came out, Wall Street Journal, Futures Magazine, Technical TNA of Stocks and Commodities, everything you can read. Now, and turning on, and while I was trading, I had the news on, CNBC. Now, it is more or less by definition or by purpose that I don't pay attention to the news, because I feel that that will more often than not serve to confuse things. What I found when I was working purely as a fundamentalist, again at the formative stages of my career, I gained a lot of information. I personally was not able to translate that efficiently and consistently into profit. So when I began to incorporate technicals into it, I improved my equity response, and my equity curve started to rise. Okay, so I don't know if the September 16th is I'm not sure. A Fibonacci analysis for time, which I do utilize, by the way. Connie Brown, who's the other, Joe DiNapoli taught me a lot about Fibonacci years ago in terms of not only for time, for both retracements and extensions, but also time points. So it might be, and as to whether or not it is a news event, I always say, yeah, allow your technical projection, however you arrive at it, both through time, price, whatever, to at least conjecture for you and project for you plausible generic types of events that might occur in the news. Certainly, I don't know what's going to happen. I expect something of significance to happen on or around September 16th. Depending on what the market's doing, I might, if I'm projecting the market to be going up, I would expect there would be events or news factors coming out that would be supportive of that in a common sense way, or vice versa. Certainly, that's the case. Quite often stocks are selling off, bonds are getting bought, you are showing same direction move, not opposite. There are, the correlation between equities, stocks, and bonds is also sometimes schizophrenic. There's the idea when, well, in general, as a starting point, I would say from an intermarket standpoint, in general, we tend to think the bond market leads the stocks. Why? It's an indirect cost of money. So as bonds go up, they're going up because interest rates are going down. Interest rates going down allow, this is the set by set, the interaction by interaction domino effect explanation, if it all is making sense. In other words, the reason bonds go up ostensibly would be because the cost of money, interest rates are declining. Well, if that's the case, corporate, companies, corporate America, stocks tend to want to borrow. And if they can borrow, they can. Raises the odds for success, and their profit margins increase. Stocks go up, their earnings ratios go up, Pre-E ratios go up. So that's the relationship there. Usually there is a delay. It takes some time for the stocks to affect the borrowing, to translate it into capital expansion and see the increase in profits and increase in PE ratios. But eventually that's the pattern. Other times, another relationship is, let's think of it from the stock side, the equity side being the generator of the relationship. People, especially on it works in both directions, but especially because of fear and emotions that are attendant to the moves. If there is a mass exodus of money, capital flows out of the stock market, and the velocity of capital exodus picks up, where does that money go? Well, money always seeks the highest return. It flows around the world, around this universe, around the planet. So money drops out of the stock market. 50, 60 years ago, as I mentioned earlier, 20 minutes ago, it went into the metals because that was a safe haven perception of, a harbor of perceived safety. The problem with that, until people like Warren Buffett came along and said, well, you can generate income by writing options against your positions, but forgetting that for the moment, just in a vacuum, once the bond market became a tradable entity, you can earn interest on it. So it replaced the precious metal sector as the next dumping ground of money, of capital, of energy, when there was an exodus of money out of the equity sector. And so eventually it's still an indirect conduit. Money does ultimately go to the metals. It's assuming, initially money comes out of the stock market, and so you see declines in equities and corresponding bidding up of bonds. Yeah, that's capital flow relationship, certainly. And but there are different relationships. Um, there are times when they move in tandem, correlated in the same direction, and that's due to but usually the bonds are going to precede there based on the interest rate play, the cost of money. There are other times when capital flows rule the day. Money, let's say, leaving one's market allows for an influx into an alternate market, and so that creates a different relationship. Our task is to figure out what regime at large is at work and see what's playing out. And then sometimes you can do it and then look at other things to see whether you're reasonably confident that that's the relationship. Other times you have an additional set of variables that it makes it difficult to get clarity in any given relationship. That's why I don't want to depend on any one relationship. What are you basing my time projections on? Again, that's the same question, folks. I have done webinars specifically on my theoretical ideas by which I am able to, that I use as a foundation to generate my time targets. I just don't have time to get into that, but I teach and think. I do a lot of my work. 80% of my decisions, curiously enough, is based on market timing. And I've spent my whole career learning how to do this. So it's based on everything that I know. I know that's not answering your question explicitly, but it's based on a lot of different models and relationships. Some are numerical, some are geometric, some are cyclical, some are planetary, some are terrestrial cycles, some are seasonal, etc. All of the above. And when all of these varied types of models and relationships converge, that's when I realize I have a time point or window, at least, for which I have a threshold of confidence for which I can feel I can incorporate it and integrate it into the price analysis that I do. Okay. From what I say, I am long the S&P and also long gold and silver. Paradoxical? Yeah. Yes. It's not, folks. If everything were perfectly straightforward, it would be too easy. There are relationships that serve as starting points and correlations that serve as starting points, but just that. They serve as starting points. And our task as market observers, when we establish a position as a trader, by extension, I'm an analyst, and then at some point I continue to be an analyst, but I add the trader. The part of the trading responsibility and duties and functionality is to observe to the extent by what the real world is showing me by virtue of the price returns that we see moment by moment, hour by hour, day by day. To what extent is a certain specified long felt trustworthy relationship or correlation, to what extent is the price action we're seeing in the real world hewing to that and moving in accordance and on that track, as it were? Or to what extent are we seeing deviations or the market making an excursion from an accepted normal relationship? And sometimes you see excursions from relationships that you normally would serve as a foundation that ultimately are paradoxical. You can have the metals moving up simultaneously with equities. Even though normally, as a starting point, there are, that it might seem they might tend to, 67% of the time move in the opposite direction. There is another percent, 27 to 33% of the time they're going to move in tandem because of monetary flows. Our task as traders is to see these nuances of deviation from a very simplistic, the good thing about a model is it creates simplicity amidst the confusion, the chaos, the complexity of a financial system. These financial markets are so complicated intrinsically from the de facto that often a model, the virtue of a model, if it's worth anything, is that it simplifies an otherwise inordinately, inextricably complicated system. That's what you get. The price you pay is sometimes you lose some precision and accuracy. So very often the worth and the substance of a model and how virtuous and how effective and integral and important it is to the extent it can create the simplification that enables you to get a further deeper view without losing some vital critical information that serves to cloud what you're seeing. So yeah, I mean, I agree with Michael, your assessment. I am currently long the market now. I could be wrong on that long. I'm long. I just happen. If remember what I said, we take out that bottom that I pointed out on the chart in the S&P, I'll get out of my long position. So I've had many of opportunities to take profits at greater amounts, but I'm still long because, we'll see. But I'm long in the metals for another set of factors. They may be paradoxically, curiously, and not mutually exclusive one to another normally. But yeah, and as such, you were thinking of it as a paradox. That can happen sometimes. All right. What was the title of the cycle timing? I don't. Oh wow. There's so many materials. There's so much. It is a subset. I don't recall that actual, Mike. I don't recall. There is the field of market timing is it's a sub. It is a field unto itself. There is most. I would say dare say 80% of my library. Read anything by W.D. Gann. Who else? Robert Miner, more recently, Robert Krauss, L.L. Jensen. It gets very. I mean, there is an entire substructure and of the business. Going back. Jeannie Long is taught me a lot of my astrocycle analysis. Michael Jenkins, Larry Pesavento, more recent. These are more recent advocates of market timing. But again, J.P. Morgan, for years, I thought he was just a major banker in our history, but he was also a speculator who understood the importance of incorporating market timing. There's a lot of different cyclical types of things that we can do. John Ehlers is a trader, a market researcher. He was had a background in electrical engineering, developed a market cycle time, MESA, maximum entropy spectroscopic analysis program I used to utilize. There's all types of market timing that one can do. Some people don't do it because they don't think it works. Some people don't do it because they don't know how to do it. Some people are just completely unaware. Some people don't do it because it is rather tedious to do. There are all sorts of ideas by which I generate time targets, suffice it to say. I just don't recall this. It's a classic because I remember I still have the book and it's numerous copies later, and I've given many copies away over to friends over the years, but I can't, there's all sorts of, if you Google anything, you can get a lot of market timing literature out there on the internet in today's world. All right, why do stocks go up when oil go up? I don't know. You could add. I don't have the answer. I can tell you an answer. I'm not suggesting it's the answer because stocks can go down when oil goes up. Stocks can go down when oil goes down. There's a myriad of there's infinite possible relation, not infinite, but there's a large amount of possible permutations of correlations when you start adding two market relationships. To some extent, stocks can go up while oil's going up. When oil finds support, when it does and starts to go up, the stock market might rally. If you're trying to figure out the fundamentally of a lot, if you purely rely on pure common sense, certainly do not do that. As an admonition of what you shouldn't do is we don't want, it's sort of a cliche, and I facetiously tell people, if you're depending on common sense to enable you to be profitable in this business, good luck with that. I'm being facetious to make a point because that's true. It's going to take more than good common sense. We need good uncommon sense to be, from a dollar and cent metric, be successful in this business at least. Certainly, stock. But to be literal response to your question, why is it that when oil goes up, stocks will go up? Well, think about the downside of oil going down. What percentage of just in the U.S., our economy is dependent on oil-related business? And how many jobs have been lost? And everything I'm saying now is fundamental, not even talking about the technicals. To what extent has declining energy prices, one might think initially it's good. Well, we'll get declined, less we can pay at the gas pump. But there's an attendant downside to this. Look at what percentage of our population is employed, either directly or indirectly by the energy business, and to what extent is declining oil prices, the profit margins decline or been so depressed that there has been tremendous layoffs in the last year in the energy sector. To the extent the energy crude oil finds support and starts going up, the stock market in a perceptual way might look at that as positive and rally. So that's an obvious way. Yeah. Oil prices rising, stopping their decline, moving up, the stock market would rejoice. Yeah, people are going to go back to work, ostensibly. I'm just saying that's one plausible how. That's easy. Manufacturing costs go up, squeezing margins. Yeah, you would think, well, lower energy costs, margins become expanded, not squeezed. But yeah, if energy prices rise, you might say that could be a reason why stocks go down. But it's a question of relative rates. Is the benefit from putting more people going back to work sufficient to overwhelm the rise in cost of manufacturing, given the energy input, the rising energy costs? All of these things really have to be, the complexity of relationships. Again, I allow the screen and the charts, the pure technician part of my brain, to resolve this, because if at any one point in time one particular relationship may rule the day between that two set of markets. But if what if, we're okay, whoever asked this, or Michael, you're asking the question, if costs go up and energy prices are a part of that cost, not the only part, but let's say that you would think that would be negative for stocks. Yeah, in a vacuum, it might, but let's bring in a third rail to that relationship. What's going on with OPEC policy in the Mideast? Are the Saudis going to raise production or cut production? Thus far, they haven't. So to the extent we continue to, so there are a lot of variables at play there. So it's very complicated. This is so complicated for me, I dare say, again, I might find it fun and challenging, kind of like analogous to a puzzle, to try and figure these things out. To what extent, even if you could conceivably hook yourself up to a set of computers at MIT or Caltech and figure out for any given point in time, any set of variables, what the net reaction and response to the market would be. If you could figure it out for one moment, the collective response of all the traders worldwide might alter that. And that's just in that very moment of time. What about a moment later, a minute later, an hour later, when the variables which are dynamic, they're not static, are changing? It is I don't know how anyone could attempt to make sense of this purely on a fundamental basis. I have, in 34 years in this business, maybe I can count on 3 fingers the number of people who have been consistently profitable solely on a fundamental front. I have nothing intrinsically against fundamentals, technicals, quantitative. It's just information. These are merely labels to give us context and conversation when one market participant or speculator is conversing with another. I think the best of all worlds today is to allow an amalgam, a coalescing of all these different types of analysis, where you see from different forms, different ideas, different thought processes, where you see alignments or clusters or convergence occur. That on a spectrum of odds tends to indicate where you should pique your curiosity and focus your attention, because your odds are going to typically correlate for a better trade at that when those alignments manifest. And that's typically what I do. Folks, I've gone way over time. I apologize. More information. Peter Newman heads our admissions department internally in our offices. You can, if you call and would like to contact myself, maybe at least, or get more information about our programs, what I do, the mentoring, etc., what our other mentors do, etc., he would be the person who could works this out, specifically the details contractually and all of that, and could give you further information. Again, you can reach us with the contact information you see on our screen, 1-800-339-8588, as well as access the website, www.pacifictradingacademy.com. Sorry for the how I tend to get caught up in this, and so I've got to figure out a way in the future so that what should be an hour plus presentation doesn't extend to closer to 2 hours. So on that note, folks, it's been a pleasure. I hope that you have been able to glean and extract something tangible from today's presentation. Again, we've got some solid relationships that provide I think some viable, relevant, objective if-then scenarios for some specific sectors. The stock market, the energy market coming up soon in oil, the bond market in particular, metals in particular, And for those of you on the agricultural front, beans either right now or in the next few weeks relative to these intercorrelations of intermarket relationships correlated with my market timing. Again, we have recorded it, and that's archived on our website as well. But again, if you'd like specific information, you can contact us using the information on the screen in front of you. Peter Newman handles all of the specifics of such. Until next time, have a great weekend, and I wish you profitable trading in the days and weeks to come. Have a great day.